Everybody, hope you're well. Hope you're enjoying the beginning of spring and the warmer weather that we are having. The markets have been volatile. You're probably well aware the war with Iran causing the markets to drop dramatically in March and rebounding on ceasefire and negotiations through April, leaving us pretty close to where we were back at the end of February. But let's dive in a little bit. Going back to 2025, the full year return plus what we've gone through so far in 2026, here's where they are, the returns for each category, really, each country or region there. You can see should have had everything invested in South Korea over the last year and a half. But as you can see there, US not as strong, although rebounding a little bit relative to the rest of the globe in this last month's rally. But you can see only up 25%. So and you can see total international there just under Canada at 45%. So a good case, as I've always suggested, for diversification internationally, different sectors and different asset classes to really build out your portfolio. But you can see there, so South Korea up 225%, but if you're 100% in Indonesia, down 16% over the last year and a half. So again, total world or total international, which excludes the US, both faring better than the US, the total world up 31.8% over the last year and a bit. So keep that in mind as we move forward. Keep this in mind as well. You can see the various returns individually there in the boxes. And obviously the red being the negative returns going in 10% increments. Not too many times. You saw 1931, worse than 40% negative. 1954 on the other side, greater than 50% return. Obviously, most of the returns are in the middle categories there, from the -10 to the kind of plus 30% range. But as you can see, looking at the overall returns, the majority being on the green side. So knowing full well that you're going to have some negative years as we move forward. The last negative full year, 2022, you can see that between the -10 and -20%. The average return roughly 10% on the markets. And that's just the cost of getting those excess returns with the risk you have to take. So good start to the year. What happens if the performance is over 5% year to date after April? So again, wasn't there in March by any means, but after April's rally, the US market is now up over 5% for the year. What happens in May? What happens the rest of the year? There's that common saying of sell in May, go away. What happens through that section, kind of the April to October section, and what happens through the rest of the year? Looking down at the bottom, you can see on average, May is higher, 64%, up a 0.5%, which isn't a terrible return for 1 month. That sell in May section through the middle of the year, up 3.9% on average and 80% of the time positive. And through the rest of the year, an 8.8% further return on average, 92% of the time positive when the markets are positive at the end of April. So good sign there. What does that mean here? Could there be more to go in this bull market? How many years does it take to get to 100% of a bull market? So we just hit that at 3.5 years since that bottom in October of 2022. Nobody knows where that's going to go, but if you look at history, total years average of a bull market, 6.9 years. Obviously, the last one from the pandemic to 2022, much shorter than that, but 6.9 years on average. And how much more room is there to go, or how many more years is there left after it hits that 100%? On average, another 3 years there. So could be more room to go. But this time, as the worst saying in finance, this time is different. So let's take a little look. Well, here we'll show you since World War II, that average of 260%. So again, just over the 100%, usually lasting a lot longer. What's going to make it last a lot longer? One thing to look at is that the earnings growth is continuing to grow and at a higher rate than the US market is. So one thing that can happen, of course, when markets are high, they can come back down, back to normal valuations, or they can just steady out, go a smoother line, flatter line, maybe even continue to grow, but not at the same rate that the corporations are growing, and those corporations will grow into those valuations. That seems to be what's happening recently anyway, with the double-digit earnings growth over the last number of quarters here, and that continues to pick up. You can see over 20% the last 3 quarters on the earnings growth, backed by technology, of course, AI and the growth there. So something positive, and a reason that the markets could continue the growth path that they've been on, and this bull market could continue longer. A few charts of interest. They always say that the stock market is a good hedge against inflation. We'll take a look at this. You can see going back over the last 30 years here, what a dollar is worth. Of course, this is US dollar, but very similar in Canada here. More than half of your purchasing power of that dollar is gone over the last 30 years. If you invested that dollar in the stock market, you're up almost 9 times. So a great hedge. Keep that in mind for those. The risk level needs to be appropriate for what your objectives are and your stage in life, but keep that in mind as a hedge, and make sure you're not under risk by having too much in cash and GICs and those sorts of things that really aren't keeping up with inflation, especially in recent years as inflation has been higher. Another interesting chart, especially for us north of the border, because our mortgage system is a little different. In the US, you lock in for a 30-year mortgage and you keep that. So that definitely affects the real estate market down there, as those with low mortgages for 30 years don't want to break those mortgages by moving. But you can see here how those rates have been, obviously with the pandemic rates hitting all-time lows at 2.65. Now, as we discuss rates, even here in Canada, looking at 4.5% or so for those renewing their mortgages, much higher than it was, of course, 5 years ago in those pandemic lows, but still way lower if you're talking to those in their 60s, 70s, 80s who were signing up for mortgages in the 15, 18% range. So keep that in mind. You don't need to figure it out. Make sure if you're looking at a new mortgage, obviously comparing rates, but really plan it out around what your life is, how you're comfortable. Are you comfortable with a variable rate? Nobody really knows where those rates are going to go. Suggestions at the beginning of this year were that rates would go up by the end of this year. And now, of course, a war pops up and all of a sudden things are looking weaker. Perhaps rates drop by the end of the year. Nobody really knows, so make sure you're planning around that. But keep it in perspective that rates are still very low relative to what we've seen over time. So I thought that was an interesting chart to look at. I'll leave that with you there. More charts to come, more discussion in the next few weeks. Anybody needs anything, just let me know. Email, phone call, either way. Look forward to chatting with you. Take care and enjoy the spring months.